Wow, what an introduction. I'd also like to extend my thanks to the Brunswick Bowling Club for allowing me to miss midweek practice last week and the week before as we were touring around. It's crucial this time of year, as some of you may know, mid-pennant season. Thanks. And by the way, when we're out there having a chat later on, do bail Tony up and get him to tell you some more stories about his days as a journalist, especially at the Fin Review. He's got some crackers about Alan Bond, some of my personal favourites. Okay, so as Ron mentioned, basically we're all overweight Australian equities and property. The reason for that is just a few common investing mistakes. I'm going to go over these one or two little investment mistakes that we're all making, and then we'll go into seeing how we can actually rectify these by using a few tools that you can use yourself at home, by buying some direct equities, or by having a look at what we do here at InvestSMART. Now, the biggest mistake I think a lot of people make is not actually knowing why they're investing. A lot of people just say they're investing to get a return, but what return? And this is really important. If you only take away two things from what I say today, besides the lawn bowls and the cooking facts, is the fact that I think you should go home and sit down and actually write out what specific return you're trying to get, and then start tracking it. Actually keep score. And you can use our portfolio manager or whatever it is that you want, but actually keep score and see how you're going against that, because knowing why you're investing and your outcomes that you're wanting to achieve, that'll actually direct you to the right products to use or the right asset class mix to have. Okay, so knowing why you're actually doing this is incredibly important. Now the next big investment mistake, or the biggest mistake people make, is just being simply overconfident. It could be in a number of areas in life, like say a bit of DIY around the house. It could even be public speaking. It could be all sorts. But with us, the reason why we're all overweight property and Australian equities are we all own a house, or we have an investment property. We bank with Commonwealth Bank. We shop at Woolworths. All of our products are with Telstra. And this gives us a sense of familiarity with them. We become overly confident, and what that leads us to do is then to be overweight in these equities as well. And so that lends us to really stuffing up our diversification and getting things incorrect, and your portfolios may look a bit like what Ron was putting up before. Now, when we're overconfident, we think, geez, well, I can get up there and do this ourselves, no problems. And you start to maybe look around for a few resources here and there to help you out. And then you maybe subscribe to too many things or read too many papers and see too many headlines and get distracted by what's going on out there. And those who were buying into the fear and whatnot, as Tony showed you on that slide of Donald Trump winning, you're reading headlines like billions wiped off markets today. You never ever hear the headline of billions put back on markets today. It's always the wiped off, and they're newspapers trying to buy clicks or get your clicks. They're not trying to help you actually, get the return that you need. And then there's brokers and advisors out there, and they're trying to drive noise in your direction as well to get you to act on something. And don't get me wrong, we're making noise ourselves. Hopefully we're making the right noises though, and conveying the right message. But there's so much noise out there that it's easy to get distracted by it. And then when we're overconfident and we're listening to the pundits and the newspapers and whatnot, we start to think that we can actually time the market. And if it's, say, waiting for interest rates to rise or perhaps the result of a certain election, we think that we can, basically jump in and out of the market and as we see fit. But I can tell you one thing, it's almost impossible to do. I know Gaurav's going to be talking about our intelligent investor growth and income portfolios. I personally invest in the growth portfolio, and I know that it is approximately 95% fully invested at all times. That is because these guys are not trying to time the market. And this is 10 of the smartest guys I know sitting there together, putting together a portfolio, and they're putting together a portfolio of high quality assets and not of cash, looking to deploy that at optimal times. So all this wraps up to make up our investment temperament. There's a few little things on the screen here. I don't know what you feel or how you feel when you hear some of these things. There's the billions wiped off markets today. Do you find yourself perhaps holding all those stocks that the talking heads on Sky News Business and whatnot are banging on about, or the people on Your Money, Your Call are calling in about all the time? So investing temperament is something that some people just will never actually have it. And if you do have it and are quite good at it, you will constantly be tested. And that's quite difficult and challenging as well. We're constantly tested on a daily basis. But you just have to understand if your investment temperament, how you react in these situations, because that overall is also going to impact your portfolio and steer you away from being adequately diversified. As I said, it'll steer all the overconfidence, the noise, the timing of the market. It'll impact your portfolio, but there are a few things you can do if you want to remain still hands-on and have that sense of control in your portfolio. A few little tools you can use to plug certain gaps where your strengths may not lie, or if you need to rebalance your portfolio and jump into a few other asset classes but don't have the expertise. There are tools out there to help you, and we'll take a look at a few of them. Now, exchange-traded funds are something that we'll talk about quite a bit. We use these extensively in our diversified portfolios. There is an exchange-traded fund out there for just about anything these days, and there will be more and more and more coming along. There's a lot there to play into very specific thematics. If you want to invest in global healthcare, you can. There's one out there, the ticker code is attractively called DRUG. If you want to invest in international cyber security businesses as a broad classification, you can. There's one out there called HACK. It's quite clever. But don't get distracted by all of these new fancy exchange-traded funds, especially the ones that are kind of dressed up. They're managed funds dressed up to look like ETFs, but they're not actually ETFs. So what we look for here basically is simple index trackers to give us broad diversification. And when we're looking at those, we're focusing on fees, because all else going perfectly to plan, an exchange-traded fund will underperform its benchmark exactly by its fees. Okay, that is what it's designed to do. So then we look for size, because the size will give us a fair bit of liquidity as well. And for example, we've recently, looking at fees and focusing on size, in our Australian equity exchange-traded fund, we've switched out of STW into the iShares 201 because they've shaved their management fee by the smallest amount. Now, the other thing to be wary of is if you're looking for diversification and you see these great fancy smart beta ETFs out there that are like income enhanced products and things like that, and you're looking for more income in your portfolio, actually have a look under the hood and see what they're actually investing in, because you might actually be doing your portfolio an injustice by jumping into those, because basically you'll be buying like 40 or 50 of the stocks in the top 200 basically, and you've seen these income ETFs actually underperform, generally speaking, the market. So just be wary if you're looking at those to jump in there. Now, one of my favourite subjects, if some of you have read my writing in Eureka Report, are listed investment companies. These are another way that you guys can look to diversify around asset classes, but still maintain that sense or element of control. Okay, having that stock there that you can trade at any time when you don't want to be in it. That can be a good or a bad thing, by the way. Now, here's a list of the top 20 LICs by market cap. And this is the biggest issue with them. It drops off pretty quickly. There's a lot of really good ones out there, and there's a number of reasons why I like LICs. However, if you all went out and after this and said, I'm going to buy into a couple of my favourites, you just wouldn't be able to. It's like you're all trying to exit that one door at the same time. The liquidity for most of these, just isn't there. But there are some significant benefits to looking at listed investment companies for your diversification. For a starter, the likes of AFIC, Argo, BKI, Milton, a lot of them are actually cheaper than exchange-traded funds. You think of exchange-traded funds as being the cheapest way to diversify your portfolio. These guys are actually cheaper. And because of the word company in the name of listed investment company, they can actually smooth out your income. So if you want to look back through AFIC, Argo, BKI, Milton, etc., through the GFC, have a look at what they did with their dividend payments. They didn't budge. They have been going up in a nice steady incline year in, year out. Through the GFC, they just maintained them and kept on going. The reason for that is the fact that they're a company. They can retain earnings and look to pay it out at a later date. And of course, you can buy them at a discount or a premium and sell them at a premium to the underlying value of NTA, which they need to report to you on a monthly basis. Some are even doing it on a daily basis. So you can use these to get instant broad diversification. Now, some of my more preferred ones I have mentioned, the likes of the AFICs and Argos. They're basically very, very similar portfolios. Just whichever one's cheaper at the time, I would look at. BKI specifically, I really like. They've just externalised their management and are looking to lock it in at about 0.16% per annum with no performance fees. In the international space, I think the team at Magellan Flagship Fund, or MFF, they have changed their name, are incredibly good, and they've lowered their MER quite substantially as well. But we'll go back to the biggest issue with these guys is liquidity. So you'd have to be incredibly patient, and to be able to buy these at a discount to NTA or even close to NTA, some of these better ones, you'll need to wait an incredibly long time. Okay, because some of them can trade at a premium and trade there for quite a significant period of time. Another way to get broad diversification that you guys can go out there and do, there's thousands of managed funds out there to give you that instant diversification that you may require throughout any asset class that you might be lacking in your portfolio. But keep a very close eye on fees here. Okay, most of them will have performance fees. That'll take away about 20% of the outperformance, so they'll give you a nice big haircut. And just be wary of the structure. Now, why I preferred the LIC structure, say, to a managed fund structure, is the fact that it's closed-ended. Once the money's raised, it's not going anywhere. Shareholders can enter and exit as they see fit. But that by selling shares, the cash or the money that the manager has is locked in. In a managed fund, that's not the case. A fund manager will typically receive inflows into the fund at the exact time they don't want to receive it, when the market's nice and high and they can't do anything with it. A fund manager will receive outflows and redemption requests from the fund right at the time they don't want to receive it. When there's plenty of stocks to be buying, but they're being forced to actually liquidate stock to pay out investors. And even if you're happy to sit there and ride through these times, you are still going to be negatively impacted by that. So it's incredibly important with all of these structures, if we go back to knowing why you're investing, to know which structure actually suits your needs and what you're trying to achieve. Now, another thing you'll also hear in funds management land and everything, that past performance is no indicator of future performance. But I must say I do like to see past performance, and the longer it is, the better for me. The reason why I say go for the longest time period you can to have a look at is because not only can you see if an investment process can wear the ups and downs of the market, but also just the ups and downs of being a business in general. Analysts come and go. Like employees in companies do come and go, and a robust structure in the investment process will be able to wear this. And you'll see the best investment houses cope with this over time, and their numbers will be doing quite well. Now, we have specifically chosen a structure for our investment products, which is called a separately managed account. The reason why we've done this is because it gives our investors, no matter what their why is, a whole lot of flexibility so we can fulfill that. Now, firstly, it is not a pooled investment. That is an important fact to point out. Like a managed fund, everyone's in the one bucket. In a separately managed account, the name might give it away, you're all in separate little silos. And that means if someone panics and wants to sell right at the worst possible time, no problems at all. We sell their stock, away they go. If someone wants to give us money at the worst possible time, when the market's nice and high and everything's too expensive to buy, no problems. They come into their own little bucket, we buy it for them, but you don't get impacted. Now, once again, with this as well, you have benefits when it comes to receiving distributions and whatnot. With a managed fund, typically it's 2 distributions a year. With a share, it's 2 dividends a year. With our separately managed accounts, it's whenever you want. You can have a monthly payment coming out. You can do ad hoc payments. You can have the dividends just flowing into your account. So it's set up to benefit no matter what your why is. And that's why we've specifically chosen to use these. Now, we have a whole, and Ron stole my part actually here. I'm a bit annoyed by that. I only saw that when he was doing it. We've got a whole range of portfolios that you can invest in. And now these ones that I've got on the screen here are asset class specific for, say, plugging your gaps. If you're happy with your Australian equity exposure but unhappy with your international exposure, you can just invest in our international model. Or perhaps if you're unhappy with your Australian investment exposure, you can actually go out there and invest in our Intelligent Investor Growth and Income models. Myself, I've invested in the growth model and the international model. And I think Ron has also invested in the growth model. Now, sorry, I'll go back to this and say when you are purchasing, say we'll look at the top 3, the international model is made up of about 6 or 7 different exchange-traded funds. And they're all individually weighted depending on how we see the overvalued sectors of the world and the undervalued sectors of the world. And our investment team is sitting back here and it's slowly dialing one up and dialing one down just to get a specific return. It may look like not a lot's happening on the surface, but these little portfolios, they're like a little duck. The team are constantly looking at them and just dialing them up and dialing them back depending on where we're seeing things overvalued and undervalued in the world. Now, it could all just be too hard, and you might just say, you know what, I don't want to look at rebalancing my portfolios, etc. That's the other big issue if you do want to go out there and buy into ETFs yourself or buy into LICs yourself, etc. It all comes back to rebalancing. You can buy the best managers out there, but if you don't constantly look at it and look to rebalance it, you're still going to end up like Ron showed us before, overweight in certain areas and underweight in certain areas at the exact time you don't want to be. Now, once again, we come back to that question of knowing why you are investing and what you're actually trying to achieve. All of these portfolios have a very specific outcome that they're trying to achieve with taking the minimum amount of risk possible to achieve it. These portfolios are not trying to shoot the lights out. We're just trying to get a steady, consistent return for our investors. And you can see here the income portfolio, and this is not the Intelligent Investor Income portfolio, it's our diversified exchange-traded fund portfolio, is trying to get a return of the cash rate plus 1%. And then we'll go up the scale. The balance is trying to get a cash rate plus 2%, growth plus 3%, high growth plus 4%. Now, as you can see, as we go up in the categories here, as our returns get higher, the time it takes to get these, we should look at making that a bit longer as well, because we're trying to ride out the ups and downs of the market. So here's the results from just, say, our balanced portfolio. Now, as I mentioned, we're not trying to shoot the lights out in these portfolios. What we're aiming to do is beat or reach that yellow mark there. That's our objective, okay? It's good that we're beating our peer group, which is the grey mark. However, all we're trying to do here is get nice, steady, consistent returns, taking the least amount of risk possible for our investors. And as I mentioned, underneath these asset classes, these portfolios, we are dialing up and dialing down our exposures to certain sectors, industries, and global sectors as well. So right now we're overweight Australian equities, but we're a little bit underweight US equities as well, and overweight emerging equities currently in our international portfolio. And with our fixed interest, we're remaining overweight on our floating rate notes, with the thematic of the interest rates to rise over time. So once again, we come back to that very, very first question. If we know what we're trying to achieve originally, then we know what products we can actually have a look at and what structures are going to suit us, and then we can look at what's going to get us a suitable return. And so that's why that why question at the start is the very most important question of the day, I believe. Great, thank you.